It begins with a contradiction that hides in plain sight. The United States claims to champion free markets and fair competition, yet global money consistently flows toward a small cluster of American banks whenever uncertainty rises anywhere in the world. Crises erupt in Asia, Europe, Africa, or Latin America. But the capital almost always ends up parked safely inside U.S. financial institutions. The mystery is not that America benefits from global instability, but how its policies repeatedly transform chaos abroad into security at home. Most people assume this happens because the U.S. economy is simply stronger, more innovative, or better managed. That explanation feels comforting, but it avoids an unsettling question. If markets are truly global and competitive, why does fear funnel money into the same American balance sheets over and over again? And why do U.S. policy decisions seem to accelerate this movement rather than slow it down? To uncover the mechanism behind this pattern, we have to return to the early architecture of the American financial system. In the 19th century, the United States had no permanent central bank, and financial power was scattered among private institutions. This fragmentation made the system volatile, prone to sudden panics, and deeply vulnerable to shocks. Economic crises in 1837, 1873, and 1893 followed a familiar rhythm. Credit expanded aggressively during boom periods. Speculation flourished, and then confidence collapsed. When panic hit, capital fled weaker institutions and regions, concentrating in the hands of those with the strongest networks and political access. Even before modern globalization, money was already learning where safety lived. The panic of 1907 exposed the limits of this fragmented system. Banks failed, markets froze, and the federal government lacked the authority to respond decisively. Instead, a small group of powerful financiers coordinated a rescue, stabilizing markets through private action. This episode planted a dangerous idea that financial stability depended on central coordination aligned with elite interests. In 1913, the Federal Reserve was created to provide that coordination. Officially, it existed to stabilize markets and smooth economic cycles. Unofficially, it became the ultimate guarantor of the U.S. financial system. This was the first step in building a structure that would later attract global capital during moments of fear. The early decades of the Federal Reserve revealed its dual nature. When credit was expanded, growth accelerated and asset prices rose. When policy tightened, contraction followed. Each cycle reinforced the central bank's authority, teaching markets that survival depended on proximity to U.S. monetary power. The 1920s demonstrated how powerful this dynamic could become. Easy money fueled speculation, not only in stocks but across the broader economy. When the bubble burst, capital that had scattered across the system rushed back toward institutions with perceived government backing. The crash concentrated financial power even as it destroyed wealth. The Great Depression forced reforms that appeared to restrain excess, but they also strengthened central control. Deposit insurance, regulatory agencies, and expanded Federal Reserve authority made American banks safer relative to their global counterparts. Stability at home became a magnet for capital everywhere else. World War II accelerated this process. Massive government spending rebuilt the economy and entrenched the alliance between the state and financial institutions. When the war ended, the United States emerged as the world's dominant economic power, and its banks became the custodians of global confidence. The Bretton Woods system formalized this dominance by tying global currencies to the U.S. dollar and the dollar to gold. The world effectively outsourced monetary stability to American institutions. International trade, reserves, and savings flowed through U.S. banks, embedding them at the center of global finance. As long as the system held, global money circulated predictably. Bottom a pattern emerged. When uncertainty rose abroad, capital moved into dollars and U.S. banks. American policy choices increasingly shaped outcomes far beyond national borders. By the late 1960s, the strain became impossible to ignore. War spending and domestic programs weakened confidence in the dollar's gold backing. In 1971, the U.S. severed the link to gold, transforming the dollar into a fiat currency backed by policy credibility rather than metal. This decision changed everything. Freed from physical constraints, U.S. monetary policy gained unprecedented flexibility. It also made global finance more dependent on American decisions. When confidence wavered elsewhere, There was no gold to run $2 in U.S. institutions. The inflationary turmoil of the 1970s revealed how policy loops began forming. High inflation triggered sharp interest rate hikes, strengthening the dollar and attracting foreign capital. Money flowed into U.S. banks, just as developing nations struggled under rising debt burdens. The 1980s deepened the pattern. Deregulation expanded Wall Street's reach, while globalization increased cross-border capital flows. U.S. banks grew larger, more interconnected, and more indispensable. Every global shock reinforced their role as safe havens. When crises struck abroad, capital fled risk and entered U.S. markets. These inflows strengthened American banks, lowered domestic borrowing costs, and reinforced confidence in U.S. assets. The loop was self-reinforcing. Instability elsewhere stabilized the American financial core. The 1990s and early 2000s intensified this mechanism. As financial innovation spread risk globally, U.S. institutions positioned themselves as the ultimate back. When bubbles burst, capital rushed toward perceived safety, and that safety was increasingly defined by American policy protection. The 2008 financial crisis exposed the system's fragility, but also revealed its power. As markets collapsed, the Federal Reserve injected trillions into financial institutions. Global investors learned a critical lesson. U.S. banks would be rescued at almost any cost. In the aftermath, regulatory reforms promised change, but delivered consolidation. Smaller institutions disappeared, while major banks grew larger and more systemically important. Global capital adjusted accordingly, favoring scale and state-backed stability over competition. Throughout the 2010s, the loop tightened. Low interest rates encouraged borrowing worldwide, but any hint of U.S. tightening sent capital rushing back to America. Emerging markets felt the strain, while U.S. banks absorbed The pandemic of 2020 pushed this dynamic to its extreme. The Federal Reserve acted faster and more aggressively than ever before, creating trillions of dollars to stabilize markets. Global investors responded instantly, pouring money into U.S. financial assets. Even as economies abroad struggled, American banks strengthened their balance sheets. Liquidity flowed inward, reinforcing the perception that U.S. policy would always protect capital. The loop completed itself once again. Inflation and rate hikes that followed triggered familiar consequences. Capital fled weaker currencies and riskier markets, returning to the United States. The same policies that strained households abroad bolstered American financial dominance. Attempts to break the cycle repeatedly failed. Proposals for global financial reform stalled, while alternatives to the dollar struggled to gain trust. The system persisted because it rewarded those already embedded within it. Today, the numbers tell a stark story. A handful of U.S. banks control trillions in assets, while global savings continue to concentrate in American institutions during every crisis. The loop is no longer subtle. It is structural. The first takeaway is that U.S. policy does not merely respond to global capital flows, it actively shapes and captures them. The second is that every crisis strengthens the central position of American banks, rather than weakening it. The third is that global instability has become a feature, not a flaw, of the system. The unresolved question is whether this loop can continue without breaking under its own weight. As debt grows, trust thins, and geopolitical tensions rise, the world may test alternatives it has long avoided. Understanding how these policy loops work is the first step toward seeing the global economy clearly. If you found this exploration revealing, stay curious, stay informed, and keep questioning where money really moves when the world feels uncertain.